Good afternoon or good evening. Welcome to Economics 330, Global Trade and Political Economy, City University of New York, MSc. Today is Tuesday, October 14th, 2025. And welcome to Office Hour and Lecture. I am Professor O. Felix Obi. And as always, we will begin with, the formal lecture, after which I would turn off the recording and we will transition to Q&A. And then after that, right after that, into our office hour. So thanks everybody for being here today. Um, in the past 3 weeks, we have completed a three-part study of the three theoretical perspectives of global trade. And these include, of course, the liberal perspective, the realistic perspective, and historical materialism. This week, we will begin a new three-part study of international trade relations and their components. Notably, these include international monetary relations, global trade relations, regional trade agreements. So, first, international monetary relations, second, global trade relations, and third, regional trade agreements. So, let's unpack this a little bit further. Um, International trade activities are driven by resource transfer, i.e., money. Therefore, one must understand the nature of the international monetary system in order to appreciate global trade relations. In a three-part study, 3-week study that begins this week, we will address the following: how nations relate to each other in the process of trade. For example, a country can limit the exportation of certain goods, or trade could be encouraged freely by one country, but limited by another. We will also address the question, what are the reasons for tensions and conflicting differences in policies? One way of resolving conflicts will be to negotiate cooperation between nations and sometimes groups of nations. And this will be multilateral and or bilateral trade agreements. Since this course is based in global trade and the political economy, we will discuss the mechanics of money and trade. Beginning with balance of payments, we will discuss how monetary flows affects the ability of a nation to transact international business with others. As an example, if a nation is unable to pay due to monetary limitations or imbalances that may be temporary, this may pose problems when they seek arrangements to help address their temporary problems. This limitation could lead to long-standing or lingering inability to participate in global trade. Thus, addressing this challenge through bilateral arrangements rather than institutional support from the IMF may lead to political control of one country by another, which in turn could create international political issues within and between countries. And I'm hoping that everyone in the class now understands that if a country were to address an issue bilaterally or seek loan facilities bilaterally, that would mean that it's a transaction between that country and another country, rather than going through international institutions such as the IMF. Let us then begin with a brief overview of the evolution and history of international monetary relations. So, historically, Gold has been used as the reference point for currencies. The system of tying currency value to gold functioned quite well until the mid 20th century. The gold standard in the early 1900s pegged the value of gold at 35 US dollars per ounce, which was the reference point other nations used in fixing the value of their currencies. It is important to note that this price was not the commodity price of gold. Indeed, private investors could not purchase gold at this price point. Government had exclusive rights over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. But then in 1944, the US government pursued an expansionary monetary policy, I'll unpack that in a minute, in a bid to financially support World War II efforts. Please note that expansionary monetary policy involves a reduction in taxes and a concurrent increase in government spending. Both measures are meant to stimulate the economy and increase the level of activity within the economy. So realize that the idea here is to increase the levels of disposable income within the society. And this is achieved in the expansionary monetary policy that the United States pursued in 1944, which of course was getting to the tail end of the Great Depression. The idea was to reduce taxes. Of course, if taxes are reduced, then net income increases. And then if you were to balance that with an increase in government spending, and then there is more money sloshing through the system. However, this policy also caused inflation and resulted in the US dollar losing value and fairly quickly. So consider this for a second. Inflation is can be essentially a function of a lot of money chasing the same amount of goods and services. Think about this. If you lived in a country with only 10 people, and after everyone buys what they need, the society can only, on average, afford 9 or 10 apples. And typically that means that at the end of the given period, the apple seller has 2 apples left over. But if all of a sudden there is a reduction in taxes, so the 10 people in this community now have more money. In addition to that, there is government spending. Let's say the government says, you know what, we're going to help everybody offset their taxes on their mortgage for the year. So now you have even more money in the more purchasing power within the economy. You can see how quickly people have much more money to spend. If you're a shrewd apple seller, you will probably now jack up the price of the apple because people can afford it. So now you're going to spend more to get less, right? And this is essentially, again, is an oversimplification, but this is really the framework that you can employ to begin to see how this expansionary monetary policy resulted in inflationary pressures, right? However, as I said, this expansionary monetary policy caused inflation to rise and resulted in US dollar losing value and fairly quickly. Consequently, other nations began stockpiling gold to prevent fluctuations in their own currency. Eventually, this practice became quite unsustainable due to placing unrealistic demands on the inflation of the US dollar. Thus, in 1944, the gold standard was abolished and replaced with the pegged exchange rate system. I will circle back later in the lecture to further unpack the pegged exchange rate system, among other exchange rate regimes. But now that we have established a foundational overview, let us then transition to this week's learning objectives, which is first, explain the term balance of payment or BOP and how this concept affects the ability of a country to participate in global trade. The answer, of course, is that balance of payment, also known as BOP, is also the balance of international payments. It is the difference in total value between the payments into and out of a country over a defined period of time. Put differently, the BOP is the method by which countries measure all of the international monetary transactions within a defined period. The BOP consists of three main accounts. The first is the current account. The second is the capital account. And the third is the financial account. Note that the current account is meant to balance against the sum of the financial and capital accounts, but rarely does. The balance of payment transactions consists of imports and exports of goods, services, and capital, as well as transfer payments, such as foreign aid and remittances. So when you send, but for those that have family in extended family in other parts of the world, when you send remit money to them, that money is part of the transfer payment that the economy of that country receives. Of course, in this case, it's going to an individual, but it is part of the broader calculation. A country's balance of payment and its net international investment position together constitute its international accounts. Globalization in the 20th century led the BOP liberalization in many emerging market economies. Developing countries lifted restrictions on BOP accounts to take advantage of cash flows arriving from developed foreign nations, which in turn boosted their economies. The second learning objective is to describe the International Monetary Fund, the IMF, and how it facilitates world trade. The answer is that the International Monetary Fund, or the IMF, founded in 1944, is a voluntary financial institution with a membership of 184 countries. It fosters among these countries cooperative monetary policies that stabilize the exchange of one national currency for another. It thereby encourages international trade. So consider that, just think about it this way. And I'm just going to pick Trinidad and Tobago for no real reason, but other than that's the country that came to mind. If you want to buy, if you're in the transportation business and you figure, I'm going to come to the United States and I'm going to finance the purchase of, say, 20 luxury buses. And the problem, though, is that these luxury buses, because you're sourcing them from the United States, will be sold in US dollar. But because your business is based in Trinidad, you're going to be collecting your revenue in Trinidadian currency. So now you can see very quickly why it is important that Trinidad has enough transactions that come into the foreign currency that come into the country so that it can use that foreign currency to be able to finance the purchase of these luxury buses that it's now going to ply the roads and make it easier and more convenient for its citizens to travel from one city to the other. Another thing to quickly think about, and I don't want to digress too much, is that now this example also highlights the importance of currency valuation, whether it is the old system that was the gold system, or whether it's the peg, or whether it's the float, which we will get into, is that for this bus driver, let's say they're going to charge 20 bucks from Point 14 to say the capital. They have to be able to recognize that they have to hope that there is a stable exchange rate between what 20 bucks in the local currency is as it translates to US dollar, because that's how they can fix the rate they can charge their customers so they make enough profit and also enough to service the debts that they incurred in buying the luxury coaches. But if the value of the local currency in Trinidad is unstable, you can see how quickly this can become problematic for the bus company's ability to service the debts that it has incurred in purchasing that bus, and how this could lead to fluctuations in the ticket price for the bus and leads to unpredictability in the economy and perhaps even hardship to the extent that the prices are going up. So again, this is just a brief overview without digressing too much. So this is why it is important that the IMF work to stabilize the exchange of one national currency for another, and thereby encouraging international trade. The IMF also provides a mechanism in which each member country can cooperate with others to promote its domestic economic prosperity and that of the entire membership. The IMF maintains an extensive database of statistics on members' economies and on the world economy as a whole, which it shares with every member country. At the request of a member, the IMF extends technical assistance in financial, fiscal, and economic matters. And this, again, just without losing too much track, going too far off the reservation, I hope that the class understands the distinction between financial, fiscal, and economic, right? Fiscal is obviously your tax policy. Your financials is your budget policy. Again, very overly simplifying it. And then economic matters is your economic planning and development. So those are distinct areas. Because sometimes fiscal policy, which is FISCAL, and financial policy can sometimes seem the same. The most simpler way to understand it is that fiscal policy is the preserve of the central bank, or the Federal Reserve, as we call it in the United States, and financial is the preserve of the Treasury Department in the United States, or often the Finance Ministry in most countries. And of course, the economic matters in the United States will be the preserve of, say, the Commerce Department, in particular, the Economic Development Administration within the U.S. Commerce Department. And at this point, and this next point actually is also just as crucial, right? And this is circling back to the IMF. If the IMF is persuaded that a member country is behind in payments to other countries, so again, if a country is unable to, say, continue to service a loan facility that it took maybe from private investors or other multilateral lenders. So if the IMF is persuaded that a member country is behind in payments to other countries or lenders, but is willing to implement reforms, the IMF will typically extend facilities to tide over the defaulting member until the reforms take effect. Lastly, the purpose of the IMF are clearly expressed in Article 1 of its constitution. The Articles of Agreement, which includes, first, to promote international monetary cooperation through a permanent institution which provides the machinery for consultation and collaboration on international monetary problems. Second, to facilitate the expansion and balanced growth of international trade, and to contribute thereby to the promotion and maintenance of high levels of employment, real income, and to the development of the productive resources of all members as primary objective of economic policy. Third is to promote exchange rate stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange depreciation. Let me quickly unpack that, and I think it's important that we understand what it is that we, as we move forward, that we have good foundational knowledge. So one of the ways, just think, larger economies are not very dissimilar from the decisions individual businesses have to make, right? Because a country's economy is the sum of its businesses and these economic activities. So one of the ways a company can sell more goods and services is by selling it for a cheaper price than its competitors. Conversely, one of the ways an economy could make the goods and or services produced within that economy to become competitive is to devalue their currency. Let's say, for instance, I wanted to take a vacation and I wanted to rent a 4-bedroom Airbnb. And let's say I wanted to leave the United States, the Northeast area. I can go to Florida, but a decent Airbnb in Florida, 3-bedroom, will probably run me about, let's say $300 USD. Let's just leave it at that, $100 a room. But you would find that if I were to go to Trinidad, and again, I mentioned Trinidad only because I previously mentioned it, I could get the similar accommodation in Trinidad for, say, $150. You could see how if I'm going to stay there, and then the airlines are also discounted, you can see how it might make sense for me to go take a vacation in Trinidad than, say, Florida. So this will be a competitive exchange rate. So now, if the folks in Florida wanted to compete, in theory, the United States wanted to compete with Trinidad, again, over simplification. The United States, if it controlled its currency, of course, our currency is a float currency, so we don't have direct control over the value of it. But our economic decisions can inspire or undermine confidence and therefore the value of our currency. But let's say for purposes of this exercise that we can control our currency. So we decide to devalue our currency less than Trinidad to make our goods and services much more competitive because we've determined that Trinidad is our arch economic rival. Then, of course, Trinidad would have to one-up us. Now, this becomes a competitive exchange rate depreciation. The problem with this strategy, why this strategy is a huge problem, is that government also needs to fund public service. And revenue is a big part of how government funds public service. If the currency is cheap, that means the government can't purchase, the government and the economy's total purchasing power will be undermined because there are still input products that you need to buy in the international market. So to the extent that your things in your country are cheaper for others with a stronger currency to purchase, the flip side to that is that things in those other countries will be too expensive for your economy to purchase. And if there are input products that your economy needs to purchase, for instance, crude oil, as one example, it becomes fairly expensive. And when crude oil, which turns to gasoline, diesel, and other fossil fuels, when it's expensive, it tends to affect the goods of most goods and services because most goods and services have to go through logistics of transportation to get to the final consumer. So this is why it's important for the IMF to promote exchange rate stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange depreciation. The fourth role for the IMF is to assist in the establishment of a multilateral system of payment in respect of current transactions between members and in the elimination of foreign exchange restrictions which hamper the growth of world trade. So uh, I think I'm going to save the what economists would consider currency manipulation, unpacking it any much further for another time. So the fifth rule is to give confidence to members by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them with opportunity to correct maladjustments in their balance of payments without resorting to measures that may be destructive of national or international prosperity. The sixth, in accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balance of payments of member states. The third learning objective is to explain how exchange rates are used to manage trade by individual nations. It is helpful to begin, and I said we will circle back to floating, fixed, and pegged exchange rate regimes. So it is helpful to begin by differentiating between floating, fixed, and pegged exchange rate regimes. Advantage of floating exchange rate currencies is that it can be traded without any restriction, which is the US model. Unlike currencies with fixed exchange rates. Hence, governments and banks do not need to resort to a continuous management process. Floating exchange rates enhance the efficiency of the market, especially as a country's macroeconomic fundamentals affect the floating exchange rate in global markets, influencing the flow of portfolios between countries. In a floating exchange rate, central banks are not required to maintain large foreign currency reserves for defending the exchange rate. Hence, the reserves can be utilized for promoting economic growth by importing capital goods. Now, I did mention in our earlier classes the importance of dialectical thinking, where you look at an issue from all sides. So we've just went through some of the advantages of a float regime. Let us now talk about the disadvantages of floating exchange rates, which includes that it is prone to fluctuations and can be highly volatile by nature, especially for emerging or weak economies, especially as one currency's value against another currency may rapidly deteriorate in one trading day. So in just one trading day, the business case for the Trinidadian transportation business importing a bus from the United States could be, undermined by volatilities in the valuation of the currency. The lack of control over floating exchange rates can limit economic growth or recovery. So again, as I said, in the United States example, we do not directly, the United States government or the Treasury Department does not directly, or the Federal Reserve for that matter, does not directly control the value of the currency. However, the market understanding of our fiscal and financial and economic policy can enhance or undermine the confidence in our economy and therefore desirability and therefore the value of the US dollar. So it's indirect, but there are consequences to policy decisions that economic policy decisions that the United States government and indeed any country with a free floating currency makes. So it's important to note and acknowledge that, you know, the lack of control over floating exchange rates can limit economic growth or recovery. And this is because when you have control, you can decide temporarily, as I mentioned, to devalue your currency so that you can stimulate exports, right? You can decide to temporarily and artificially inflate the value of your currency so that you can make imports much more affordable to the extent that that's part of your economic development strategy. So the negative currency exchange rate movement may lead to serious economic challenges. As an example, if the dollar rises against the euro, the US goods and services will become more expensive, and all things being equal, less competitive for exports to the Eurozone. If a country is suffering from economic issues such as unemployment or high inflation, floating exchange rates may intensify the existing challenges. As an example, depreciation of a country's currency in an economy already suffering from high inflation will cause inflation to increase further, thereby intensifying economic hardship due to reduced purchasing power. Additionally, expensive imports may worsen the country's current account. Now, the next exchange rate regime is the fixed exchange rate, also known as the gold standard, which quantifies the value of currencies by using a stable reference point. As I previously mentioned, historically, gold has been used as the reference point. This is because it is a valuable commodity worldwide, and its value is less susceptible to fluctuations in interest rates. The next is a pegged exchange rate system, which incorporates aspects of floating and fixed exchange rate systems. Smaller economies that are particularly susceptible to currency fluctuations will peg their currency to a single major currency or a basket of currencies. These currencies are chosen often based on which country the smaller, or typically chosen on which country the smaller economy experiences a lot of trade activity with, or on which currency the nation's debt is denominated in. Rounding up the class, it is helpful to note that countries should have a macroeconomic growth strategy, a theory of growth that may include a combination of A, an import-led economy, B, a domestic consumption-led economy, C, an export-led economy, although in practice, a theory of economic growth often incorporates elements of all three. So this concludes the formal lecture section of today. But please note, this is really important announcement, that next week, Tuesday, will begin a 2-week period for your term paper, which will serve as midterm exam. So let me say that again. Next week, Tuesday, will begin a 2-week period for your term paper, which will be in lieu of a midterm. So for the 2 weeks beginning next Tuesday, you will not have regular weekly assessments. You would instead write a term paper. I will deliver an overview of the term paper/midterm next Tuesday rather than a regular lecture. Of course, I will also post the term paper guidelines on the class Brightspace page. Until then, I will now turn off the recording and take questions as they come. So